New data from the Bureau of Labor Statistics and the Department of Labor is showing a big slowdown in job growth in America. Most notably, we just had some of our worst months for job growth since the pandemic in 2020, and now hiring is about 84% below its long-term norm. This big slowdown in hiring is now causing some people to be concerned that we could be entering a job market's recession by the end of the year and that the Fed is now jacking up the odds of multiple rate cuts as a result. And you can see here, the big issue is the payrolls report in August. 22,000 jobs were added in August 2025. That was less than expected and a further sign of a hiring slowdown. Even worse, folks, in June, there was a net loss of 13,000 jobs in June. So this is some of the worst figures we've had on the labor market in a really, really long time. And if we take a look at this, you could see the last 4 months in particular, May 2025, June 2025, July 2025, August 2025, we've averaged only about 22,000 jobs added per month in the last 4 months. That's about 84% below the long-term monthly average of 149,000 jobs added. So this is like the type of thing you would typically see prior to a recession. I'm going to call this like a pre-recession signal from the labor market. We're not in a recession yet in the labor market, but some of this data reported by the Bureau of Labor Statistics is really concerning, is really starting to suggest that we could be rolling over. And one industry we're really seeing the rollover occur is with home builders in the housing market. Different news reports are now saying home builders are starting to do layoffs and the construction industry is starting to do layoffs as well. And the interesting question to ask is, what is this going to mean for the housing market? What is this going to mean for the stock market going forward if the job growth continues to go down? Well, what it's going to mean for sure is lower interest rates. That's one thing that seems to be happening. People are dialing up their odds for the Fed to cut interest rates multiple times by the end of the year. In fact, mortgage rates plummeted on Friday when this jobs report just came out. The 30-year fixed mortgage rate, everyone, take a look at this. And I'm live, by the way, so get ready to give your requests. I'm live here streaming on a Saturday in Nashville, so get your requests if you're a channel member ready. But you could see here the mortgage rates dropped to 6.29%. Just in one day, pretty much, they went from 6.5 to 6.29. And those mortgage rates are still, let's just call it unaffordable given where prices are. But you can see there's definitely some downward pressure on interest rates because people are now thinking and believing that the Fed is going to cut interest rates multiple times and that the economy could be heading into a recession. And I know, the R word recession is a bit like boring at this point because we've heard the recession call so many times the last 3 years, in 2022 and 2023 and even in 2024 and even in 2025 with the tariffs. A lot of people said, oh, the recession's going to come. The recession never came. However, this is the first time we are truly seeing job growth figures that are suggesting a recession could be here. And you guys as home buyers need to start preparing for that, right? If you're, looking at buying a house, you should start thinking about what's the housing market going to look like with flat or negative job growth. Like if we have negative job growth over the next year, according to the BLS data and some of these other sources I'm about to talk about, what's that going to do to home buyer demand? What's that going to do to renter demand? Well, I think ultimately it's going to lead to flat or lower demand for housing. I mean, if you have flat job growth, what's that going to do for demand for rentals in particular? We're seeing landlords say over the last year that the demand for rentals has been good, but if the job growth is going down, that's probably going to lead to less demand for rentals in the future, might lead to rent cuts in the future. In fact, we're already seeing rents go down in quite a few cities across America. This is really an interesting thing that not a lot of people understand. The rents are dropping in some cities by quite a bit. And there was a new report from RealPage, a big apartment data source. They were talking about the markets where rents have dropped the most over the last year. Take a look at this, everyone. Rents are down 7.8% year over year in Austin, 7.8% year over year in Denver, 5.6% year over year in Phoenix. Now think about this in the context of the labor market, everyone. Could we be seeing like early labor market and economic warning signals in some of these Sunbelt housing markets where the rents are already dropping by a lot? Then you have San Antonio, rents down 4.9%. Las Vegas, rents down 4.3%. Dallas, rents down 3.4%. Orlando, rents down 3.3%. Jacksonville, Charlotte, Fort Worth, rent contractions already happening. And RealPage actually said, they noted that after showing resiliency in recent years, the US apartment market saw the return of mild annual rent cuts in August as occupancy softened. So they're showing that occupancy dropped and that rents are now down year over year on an annual basis in the US. This is the first time that's happened since March 2021. So first time we've had annual nationwide rent cuts since March 2021. Now that's interesting, because this is also the first time that we've had negative job growth. We had negative job growth in June. That's the first time that's happened since December 2020. And in fact, the job growth in America over the first 8 months of 2025 is 580,000 approximately. So we've added 580,000 jobs in the first 8 months of this year. That's the lowest job growth for the first 8 months of this year since 2009, if you exclude the pandemic. And the reason I'm kind of underscoring these figures for you all is so you have a good lay of the land about what's going on in the economy right now. You know, when you see the US adding 598,000 jobs and that being the worst start to a year since 2009 outside of 2020, as reported by the Wall Street Journal and the Bureau of Labor Statistics, that's telling you something is going on in the economy, right? And ultimately, I think what some of you might be hoping, right, is if there is some economic volatility, if there is an economic job market recession that happens in the next year, that could lead to maybe some forced selling on the US housing market. Maybe some people are going to be forced to sell their homes. Maybe inventory is going to go up by more in the future. Maybe we'll see home prices drop more in the areas that are most negatively affected from an economic standpoint. But I actually ran the data on this, everyone. And I just thought it was really, really interesting. Like, how much does the job market actually matter in terms of predicting the economy? And I know that sounds almost like a crazy question, right? Like, how much do jobs being added and subtracted matter for the future of home prices and stock prices? Is kind of the question I was asking myself, and for predicting recession. Versus, how much does the stock market matter for predicting a recession and future declines? Because the one thing that I think is not really resonating maybe with some people is like, oh, on one hand, we have this labor market, which is clearly slowing, but then we have the stock market, which is at an all-time high. The stock market just keeps going up. I mean, it's crazy. I mean, the resiliency of the stock market is something to behold almost. I mean, the S&P 500, everyone, can you guys guess where the S&P 500 is right now? It's at 6,500. I mean, that's up more than 3x from 10 years ago. It's up more than double from pre-pandemic. You know, the stock market just keeps on going up. And I think the stock market going up is something that is maybe leading to some sellers on the US housing market not being as willing to cut prices. Maybe it's leading to this kind of suspension of disbelief that the economy is fine because people just keep checking their 401ks. You know, you check your 401k and you see it go up and you see it up 20% since last year, and you're going to say to yourself, well, you know, the labor market might be slowing, but I still have a job and my stock portfolio is going up. So maybe, you know, maybe things aren't that bad. And I would say, you know, things aren't that bad overall right now. And I think this is kind of like a mixed picture, right? The job market is slowing, but it isn't yet tanking. The stock market is still high. The housing market is in a recession, right? We have these like different segments of the economy all doing different things. And how do you interpret that to make a better decision as a home buyer, to make a better decision as an investor? You know, it's a great question. I actually have some commentary from one of you here in the chat that I'm going to bring up right now because I think it's really interesting. And if you guys want to leave some of your requests, you can here in the chat. Derek basically is talking about how his import business sells into the Americas, opened up a foreign office since Trump policies and hire foreigners, not Americans. All our foreign customers are planning businesses and doing it around the USA. My point is, I suspect we are heading towards a huge decline in employment, income, and housing. Well, that's what Derek is saying based on his business. I mean, you guys can let me know what you think. Are we going to see a further decline in employment? Are we going to see a decline in income? It's an open-ended question. I think if you look at what's going on in certain housing markets and you view the housing market as a leading indicator, that would tell you we are heading towards a downturn, particularly if you look at home builders. I mean, home builders now are doing big layoffs. According to Rick Palacios from John Burns Real Estate Consulting, 63% of home builders they survey say layoffs are happening. So John Burns Consulting, they're one of the biggest data companies in the housing market. They do a lot of research, a lot of surveys. 63% of home builders they survey say layoffs are happening. 87% of builders in Texas say layoffs are happening. 79% of builders in Florida say layoffs are happening. 75% of builders in Northern California say layoffs are happening. So Texas and Florida home builders, 80% plus are seeing layoffs. And if we go and look at the data from the BLS, we could see residential building construction employees are declining. Specialty trade contractor employment is declining. And one kind of potential controversial thing about these job numbers, everyone, is that there's some skepticism that people have over the government job figures, right? They tend to get revised down. In the last couple of years, they've been consistently revised down. And then Trump fired the head of the BLS about a month ago. There were some questions about the veracity of the report a month ago. So, people are starting to question, are the government job figures accurate? These government job figures have very low survey response rates. Now only like 50 to 60% of businesses actually respond to the government job surveys in the first month that they're given. So, are these government job surveys even accurate? And, what are the other data sources saying about employment in the labor market? And where is the labor market going to, according to some alternative sources? This is something I wanted to look into because, if you're just relying on one source to tell you where the labor market's heading, you might be missing it. So what are some other sources saying on the labor market? Well, I dug into this data because I want you all to be, understand what's going on. And one of the data points here I was looking at is called the ISM Services Employment Index. Now, this is from the Institute of Supply Management, and it's an alternative gauge on the health of the labor market in the services industry. You can see here this data goes back to 1997. Now, it's pegged around 50, so the average is 50. So if we're at a 50, that means basically neutral employment. If we're at above a 50, that means employment's expanding. If we're below a 50, that means employment's contracting. Well, currently the ISM Services Employment Index is a 46.5, which is in contraction territory. In fact, if you exclude the pandemic and a little blip in 2023, this is more or less the lowest that we've seen on ISM Services Employment since 2008. Additionally, ISM also comes out with a manufacturing employment index. You could see that today we're at a 43.8 on the ISM manufacturing employment index. That's well into contraction. Again, a 50 is normal. So if we're below 50 on this employment index, it means contraction, and we're well below 50. I mean, if you exclude the pandemic, we're at the lowest level of employment growth, or I should say we're at the highest level of employment contraction in manufacturing since 2008, 2009. So, here's some alternative sources on the labor market, which are saying similar things to the BLS job survey. Contraction, contraction, slowdown, slowdown. To be clear, we're not in a free fall. We're not seeing layoffs surge in a way that they did in late 2008, early 2009. In fact, the unemployment claims are still pretty low. So while hiring is slowed, the job market is stalled, might even be going negative in certain industries, we're not seeing yet a big surge in layoffs. And the initial unemployment claims are actually at a still historically low level. So we don't have that many people going out claiming unemployment insurance. So again, we're not yet in a major recession in the job market, but we're in this pre-recession scenario. And one of my other channel members here just had an interesting comment I want to show you guys. He's talking about how he's a big buyer of low value REO. And this is JD. He's a big buyer of low value REO. REO inventory is still at extreme lows, probably down 90%, seeing increase in weekly inventory from auction houses and servicers. So one interesting way that we would see labor market distress flow through to the housing market is through more foreclosures, is through more mortgage defaults, and through more REOs, everyone. So what an REO is real estate owned. So REO, real estate owned. Let's take a look at this so you guys can understand. Real estate owned refers to properties that a lender, such as a bank, owns after a foreclosure sale fails to sell the property at auction. So they do a foreclosure sale, it doesn't sell, the bank then owns it, which the bank doesn't want to do. The bank never really wants to own property. And if you see the REOs going up, that's definitely a signal of labor market distress. And why don't we actually see where the labor market distress is right now? And again, folks, I'm live, so if you want to get your requests and your questions in, join as a channel member, hit the join button below to join as a channel member, and I will try to get to your requests. But in the meantime, let's just look at the health of the mortgage market, because this is this would tell us a lot. Like, are mortgage defaults high? Are they low? Are they going up? Are they going down? Well, according to the ICE Mortgage Monitor, the delinquency rate is up. The foreclosure starts are up, actually 10%. Foreclosure starts are up 10% month over month, and they're up 36% year over year. So we are seeing that lift in foreclosures, foreclosure auctions, foreclosure starts that JD was talking about. However, the overall mortgage default and delinquency rate is still below the long-term average. So we're at 3.4% delinquency rate on first lien mortgages, 4.2% is the long-run average. And you can see we've just been below this long-run average since the pandemic. However, there's a big difference in the type of mortgages and if we're having defaults or not. FHA mortgage defaults are way up. FHA mortgage defaults are at their highest level in over 10 years if you exclude the pandemic. VA mortgage defaults are up, but the GSE mortgage defaults, the Fannie Mae, Freddie Mac mortgage defaults are still pretty low. And this ICE Mortgage Monitor actually has a lot of interesting data on the mortgage market. And if we do continue to see mortgage defaults and foreclosures rise, it is reasonable to expect that we will see heavier downward pressure on prices in some areas. Let's see, they typically break out some market by market data here. I'm going to see if they have some of this market by market data. I haven't had a chance yet to look at this one yet, but I think what's interesting to me is as you look at this map of home price growth by metro, you can see they're showing some big drops here. Big drops year over year in Florida, some drops now in California, drops in Texas on home values. These drops in home values are occurring still at very low mortgage default rates, right? So if we were to see the labor market worsen, we were to see job losses, more job losses, it's reasonable to think mortgage default rates would go up. Yeah, I mean, even some of these markets, folks, some of these markets are way down in terms of home prices from their peak. And so this is something you guys need to watch out for. And, I just ultimately think the labor market is going to have a lot to do with if sellers are going to get with reality. I think the big thing we're seeing in the housing market is a tale of two housing markets. On one hand, we have like some sellers that are coming to market and trying to sell their house at a fair price and accepting below market prices to sell. That's one half. The other half of sellers are basically coming to market still thinking it's 2021, 2022, 2023 in terms of the prices they can get, and they're not really budging off that. So even though we're seeing a housing market downturn in a bunch of different cities in the US, a bunch of different states, even in those areas, you're still going to see certain sellers list high. You're still going to see certain sellers disconnected from reality. But what you got to pay attention to, folks, is what houses are actually selling for and what condos are actually selling for. Because the more I look on the market at different listings, the more I am seeing some big declines. And this is one example in Fort Myers, Florida. I want you all to take a look at here. Fort Myers, Florida, this is on the west coast of Florida. And This is a condo, two bath condo that just sold for $350,000, 1,700 square feet. So this is a big condo in a high rise in Fort Myers. Now, what did this condo previously sell for? Do you guys want to guess what this condo sold for about 3 years ago? I'm going to show you here in a second. This condo sold for $575,000 in March 2022 and now just sold for $350,000. So the owner who bought in 2022 took a $225,000 loss on this condo in Fort Myers, and actually its recent sale price is below its pre-pandemic pricing. So, you know, we have these houses and these condos transacting in Florida at prices below pre-pandemic pricing, down 200, 300,000 from what they sold for 2 or 3 years ago. And this is a clear indication the downturn is playing out. Here's a house in Port St. Lucie, 3-bed, 2-bath house, 1,200 square feet. This sold for $225,000 in August, $225,000 in Port St. Lucie, St. Lucie County, on the southeast side of Florida, east side of Florida. What did this house previously sell for? This house sold for $362,000 in 2023 and now just sold for $225,000. So this house sold at a $140,000 loss from what the previous owner bought it for. And the reason I'm showing you these individual listings, everyone, is because I want you all to understand that even though the market can appear frustrating, even though it can appear like some sellers aren't cutting prices, some sellers are disconnected, understand that there are sellers on the market who actually are selling at big discounts, and that you can actually get a hold of a house at a big discount if you're diligent in terms of making offers, if you're finding the right areas to make offers. So it's really important to understand. We have another condo here in Sebastian, Florida. This is a 2-bed, 2-bath condo, 1,200 square feet. Just sold for $160,000 in May of this year. Previous sale price was $265,000. So the owner here took a $100,000 loss. Again, this condo sold for below its value prior to the pandemic. So rest assured, everyone, the labor market, it's moving towards an area where it's stalling, might even be going negative. Stock market still at an all-time high. We'll have to see how long that lasts with the stock market. I think the stock market's like a really interesting component here, and I'm going to get and take more of your requests in a second, but I just want to talk about the stock market here, because the artificial fuel that the stock market is giving the economy, right, in terms of consumer spending, I think can't be understated. One of the reasons why the economy is still holding on and GDP is still forecast to grow at 3% in the third quarter, and why earnings growth is still good for a lot of publicly traded companies, is because the stock prices for people who own stocks are through the roof. Like the 401ks are through the roof. Stock portfolios are through the roof for the wealthiest Americans, right? And the wealthiest Americans tend to control consumer spending. So I think the statistic from the Wall Street Journal that I'm about to show you is that the richest 10% of Americans control half the consumer spending. And again, if you're just trying to like figure out what's going on in this economy, like why does it feel like there's all these different things happening? Like certain indicators are pointing down, other indicators are stable or pointing up. Understand that there's this bifurcation. The highest earning 10% of Americans have increased their spending far beyond inflation. Everyone else hasn't. This is from a Wall Street Journal article, February of this year. And you could see it was based on analysis from Moody's Analytics that was showing that the top 10% of earners now account for half of all consumer spending, right? And so that's why, the earnings reports for the publicly traded companies are still decent, because the spending is still decent, because the spending is being increasingly propped up and controlled by the top echelon, the higher wealth people in the economy. Additionally, if you were to look at, the share of corporate equities and mutual funds held by people in the top 9%, 90th to 99th percentile, 37% of all stock portfolio is held by people in the 90th to 99th percentile in wealth, which is crazy. And then if you were to go actually to the top 1%, everyone, the top 1%, it's 49%. So what that is saying, if this is absolutely wild, everyone, like take a look at this data. Share of corporate equities and mutual funds held by different wealth percentiles. 37% of the wealth is held 90th to 99th percentile. 50% of the wealth is held 99th to 100th percentile. So literally 86% of stock market wealth is held by the top 10% of income earners. And so when you see that, you understand why the top 10% of earners now account for half of all spending. And that's ultimately keeping the corporate earnings strong. Corporate earnings were up about 13% year over year. And I don't think we're going to see like the major recession happen until corporate earnings start to go down. Like at some point, consumer spending would need to go down, corporate earnings would need to go down before we were to see like, the recession that you all are thinking in your head of like what could happen like 2001, 2008, 2009. Like we've seen the labor market slowing, housing market has slowed, housing market's going negative, but until consumer spending really starts cracking and until the top 10 to 20% of people start spending less and then the stock market earnings start going down, we're not going to see like that next level of the recession. Of course, that could definitely happen over the next, 3, 6, 12 months. And if the labor market continues to slow and go negative, it increases the probability. But one thing I wanted to do now, everyone, is just give an analysis and an update on where we are in all the different housing markets, right? So with this backdrop of the slowdown in the job market, right? How is this impacting different housing markets? What's the situation going on in terms of home values? And, are we seeing a relationship between like where home values are declining and where the labor market's declining? And the first thing we're going to look at here, folks, is home value growth over the last year. So what are the states where values are dropping? What are the states where values are still going up? You can see Florida is the state where values are dropping most, minus 4.7% year over year, according to data available on Reventure app in Florida. Now, I was just showing you listings that sold for 30% below where they were a couple years ago. Understand that minus 4.7%, I think this is underselling how much values on certain homes are going down. Comparatively, in New York, values are up 4.4% over the last year. So New York and Florida, we're at like the different ends of the table here on home price appreciation. New York's up 4.4, Florida's down 4.7. Another state that's down is Arizona. Arizona is down 3% year over year on home value growth. Meanwhile, a state like Wyoming is up 5.2%. And most of these variations in terms of what's influencing home value growth, it's actually not job growth. I actually pulled the data on job growth by state, and the strongest job growth is actually still in the South. So the strongest job growth in America year over year is in South Carolina. Jobs are up 3.4% year over year. Jobs are still up 1.3% in Florida. Jobs are up 1.6% in Texas. Jobs are up 1% in Arizona. So we're still seeing jobs grow in the South, but by less than they used to. Jobs seem to be flatlining in the Midwest to the Mountain West and the Pacific is where jobs are flatlining, and they're still doing okay in the Midwest and Northeast. You could see that there isn't much of a correlation between the job growth and the home value growth. And the reason is because it's inventory which is impacting home value growth. So the inventory surplus right now matters a lot more than the local job growth. So Colorado has a 55% inventory surplus. Florida has a 55% inventory surplus. Tennessee has a 54% inventory surplus. These are the things that matter most, right? Anything like that's being flown through from the job market, like say jobs are going down in your city or state, it's going to show up in the housing market data, right? It's going to show up in inventory. So like, I now moved back to Tennessee. Everyone here locally still says all the narratives about people from California moving in and all the jobs and all the construction and XYZ. I look at the data, I see 33,000 homes now on the market in Tennessee in July 2025. That's the highest level that we've seen in the last 10 years for July. So in some ways, I don't want to actually say the job market doesn't matter. The job market does matter. But what's great about the housing market data is you get an immediate signal about what's going on, right? Inventory is going to tell you a lot right away about what's going on in your local economy, local housing market. So will home sales. What are the home sales like in Tennessee? Well, they've dropped significantly from the peak. and they're below the long-term average. That's starting to give you an indication, oh, we expect a correction. Reventure's forecast in Tennessee is minus 5.2% over the next year. What are some other states that we can analyze? Let's talk about California. I actually haven't talked about California in a couple of videos. Well, you can see in California, values are down 1.2% over the last year. Okay, little mini correction, just starting. Now, why is that correction starting? Well, it's inventory. There's 78,000 homes now on the market in California, which is the highest since 2019. Third highest in the last 9 years. But what's really starting to push California down are home sales. Now, this is wild. Check out the home sales in California. We're at 41,000 in July 2021, according to data from Redfin, available on Reventure app. That's now down to 24,000 home sales in July. So what is that, everyone? That's like a 40% decline in home buyer demand in California. Now, for the longest time in California, you didn't feel it because the inventory was still low, but now the inventory is back to normal while the buyer demand has plummeted. So you see inventory back to normal, buyer demand plummeting. We now have a negative downward forecast in California. And that's how you can use this data. If you're a prospective home buyer or investor, you can use this data to make more educated decisions to actually, again, take yourself out of the headlines of what's going on with the job market on a national basis and look at the exact data for your market, your city, your state. In terms of Florida, one big thing that concerns me with Florida is also home sales. Florida home sales are down from 47,000 down to 28,000. So Florida home sales are literally the worst they've been since 2012. Buyer demand in Florida is the lowest in 13 years. Meanwhile, inventory is the highest in over a decade. So we expect values in Florida to drop 6.4% over the next year at Reventure app. They're already dropping by quite a bit. But really what you're going to want to do, folks, is you're going to want to dig into this data at the metro level, at the zip code level. Because if I go and I basically look at what's going on, say, in Tampa, and Tampa's a market where, I don't know if you guys are aware, we've had huge declines in a lot of areas in Tampa over the last year. Some areas down 9%, some areas down 17%, right? Another market like this would be Austin. If we go to Austin, you could see huge declines over the last year, 10% in a year. Some of these zip codes are down 10% in a year. And I want you all to remember, like, I lived in Austin in 2020, 2021. I remember when everyone was saying, oh, Tesla moved their headquarters to Austin. Do you all remember that? Tesla moved their HQ to Austin. I think they moved the manufacturing plant to Austin in 2021, 2022. I just remember everyone saying, oh my gosh, prices are going to go up forever because Tesla moved here. Fast forward 3 years, Austin is in a free fall, and home values in Austin keep dropping. And we're still forecasting. If you go to our price forecast in Reventure app, we're still forecasting minus 10% for some of these zip codes over the next 12 months. And this just highlights the importance of the data and not to get lost too much in the announcement of like jobs, companies moving. One city now that's benefiting from this is Huntsville, Alabama. Because the Trump administration is moving, I believe it's Space Command, from Colorado Springs to Huntsville. Now, for those of you who don't know, Space Command, it's like this newer branch of the military, and it was in Colorado Springs. Now it's going to be in Huntsville, Alabama. And Huntsville, Alabama already has like a presence with the Army and the military and Redstone Arsenal, and this is undeniably good for Northern Alabama. But I'm already seeing headlines like Huntsville real estate. I'm already seeing headlines say like, oh, home values are going to boom. Let's see here. Let's go to news. Yeah, buy a home now to avoid Space Command rush in Huntsville. Here is why that might be a good idea. Experts, time to buy is now after Space Command announces move to Huntsville. I just can't help but laugh at this, everyone, because I've lived in so many cities now that I've seen so many different versions of this type of headline. Oracle's moving to Nashville, buy now. Tesla's moving to Austin, buy now. Space Command's moving to Huntsville, buy now. So if you live in a city where this is happening, like, do the research. So let's just do it. Let's look at Huntsville, and this is a market I do like. I like Huntsville in the long run. But should you rush to buy now in Huntsville because Space Command is moving there. Well, let's just look at the data. In Huntsville, values are flat over the last year. However, we think they're going to go down 6% over the next 12 months here at Reventure app. So we have a negative downward forecast for Huntsville. This used to be a huge seller's market. Now it's a big buyer's market. The reason why inventory in Huntsville is through the roof. 2,800 homes on the market. Look at that V shape. Inventory bounce back. In 2021, there was only 450 homes on the market in Huntsville. Now there's 2,800 homes on the market in Huntsville. Are any of these news articles talking about that? Absolutely not. They don't want you to see the data. They want you to just read the headline. I wouldn't be surprised if maybe a realtor company paid some of these news outlets to write these type of articles. I'm just speculating with that, by the way. I'm not saying necessarily that happened. But let's look at some other data. So if we were to look at the number of home sales in Huntsville, how's that looking? The number of home sales was 1,100 in July 2020. Now it's down to 728. So home sales are down roughly 35%. And again, I think this is a good market in the long run, Huntsville, Alabama. Strong population growth, 14% over the last 5 years. But that doesn't invalidate the realities of what's going on in the housing market right now. Again, folks, the best measure you're going to have of your local housing market and its health is the inventory, is the days on market, is the price cut rate, is the home sales figures. So if you are a buyer or investor looking in 2025 and you're seriously considering buying over the next 3 or 4 months, because folks, there will be some good deals over the next 3 or 4 months. I think if you are in one of these markets that is declining and that has a heavy downward forecast, you should be looking. You should be looking in Huntsville. You should be looking in Austin. You should be looking in Tampa. You should even be looking in parts of Southern California, Phoenix, Las Vegas, and Denver right now, because those markets are starting to see some big downward forecasts. Just understand that the leverage is in your favor. The leverage is not in seller's favor right now. It's in your favor as a buyer. And the more the downward forecast is in your market, the more that the leverage is in your favor, the more room you have to negotiate, and the bigger the opportunity you have to get a deal on your house. And so if you're interested in doing that, if you want to explore the markets with the biggest downward forecast where you can get a house potentially below market at a discounted rate, do this. Go to www.reventure.app. This is the program I actually invented for you guys to do research on the housing market. And just start by typing in your zip code. Type in your area and look at the basic data and then check out the home price forecast, right? That's really the most important data point we have. Where are prices heading in the next year based on the data in the market? And that can inform your offer strategy. And to access that data, sign up for a premium plan. The premium plan on Reventure app costs only $49 a month. That's less than 0.01% of the cost of buying a house. And then the annual plan, actually, we just knocked down to $33 a month relative to the monthly pass. So you're going to save 32% if you do the annual pass, which is only $399 a year, less than 0.1% of the cost of buying a house. Ultimately, upgrading to the premium plan and looking at that price forecast is going to help you as a buyer save money, potentially tens of thousands of dollars on your home purchase, because you need to understand where the market is heading before you make that decision. And in terms of the labor market, everyone, a slowing labor market will likely mean more homes for sale in the long run, will likely mean bigger discounts on real estate. The mortgage rates are down to 6.3%, so we'll have to see if lower mortgage rates brings more buyers back in. I think it might bring some buyers back in, but I don't think people are going to be rushing to buy homes if they don't feel confident in their in the labor market, in their job, or finding a better job in the future. So hope you guys enjoy this live stream. Head to www.reventure.app and sign up for that premium plan so you can see the 12-month forecast in your zip code. And until next time, this is Nick from Reventure signing off.